but make sure that my expected return is much higher than, let's say, putting my money in the bank or a treasury bill from the government of Canada. I need a risk premium. So that's what we're trying to determine here. How much of a risk premium? We talked about the cost of capital. Okay. And think about now the cost of capital as representing financial risk. Right? The more that I go in debt, which is not necessarily bad, the more the financial risk of the company. On top of that is operational risk. So let's say I've got my optimal capital structure, then there's the risk associated with running my business and all the attendant risk of making bad decisions or making decisions that is happening not according to plan. So we've got operational risk and we have financial risk. And one of the examples I'm going to talk about when we're working in an international marketplace, we'll also have foreign exchange risk. So it's 3 layers of risk in terms of an engineering project in an international market. We'll talk a little bit about how we might mitigate some of that risk. So we want to make sure that risky projects indeed do return what our shareholders want, at that sort of risk premium. And we want to be rational about this thing and try to quantify as best as possible. It's a tough job in terms of trying to decide what to do, but nonetheless, we have to deal with ambiguity. So I want to just touch on some techniques around this. But more importantly, I want to sort of motivate why people are risk averse. This is an example of 2 alternatives. One is an oil well, and the other one is real estate. Okay. Let's start with real estate first. Well, 60% chance of making your share of $10,000. Okay. There is no chance of losing all of your money. The building's always going to be there. We're insured, so if it burns down, the insurance picks it up. Right? So it's sort of safe in the sense that I've always got a building there and it's valued. If occupancy is really high, and I got 100% occupancy because there's lots of people that want to rent the place, I'm going to make a little more money. And if the market is soft, I've got a high occupancy, a low occupancy rate, high vacancy rate, and I might not make as much money. I'm never going to lose it all. Now think about now an oil well. Okay. Well, you never know how much oil is down there until you actually start drilling. Yes, the geological engineers can do their best estimate as to, given all their tools that they have, but in the end, you've got to go down and drill and spend all the money before you know how much is down there. So more than likely, they know what they're doing, and we sort of have this normal return of $10,000 on the investment. It's a normal one. So they've done their engineering, and they find the oil, and we extract it. Sometimes they're wrong, and there isn't very much down there. In this case, we spend all of our money putting the drill in, and nothing comes back up. We've lost everything. Or we got a real gusher. There's oil that they couldn't see, and we're going to make lots of money. So think about the nature of risk, variability of cash flows. Real estate, there's not much variability, right? Certainly you're never going to lose all your money. There's a lot less risk. Much more variability in the oil. But think about the return. Okay. Well, hopefully everyone's had some basic stats and knows about expected value. That's all this is. Okay. If I look at the expected return, if I do this a dozen times, what's my expected return? Well, I don't necessarily know on the next project what I'm going to make. But just like flipping a coin, I don't know when I flip the coin if it's going to be heads or tails. If I do it 1,000 times, 500, give or take a few. Same thing here. So the expected return is $10,000 in either case, right? Because I'm just weighting the probability against the outcomes to give me a sense of what the return is. What this suggests is there's no risk premium for the risky oil well project, right? Because either way, I'm going to expect a return of $10,000. Take the investment, I don't know what I'm going to get on this particular one, but on average it's 10. So a risk-averse investor would normally take the real estate investment. There's nothing in it to take the additional risk. Well, what type of investor might decide that project A is worth doing? Well, perhaps a real risk taker. In other words, the value associated with making $20,000 far outweighs the losing all of your money. Right? That's not normal. That's not what most people would do. They would say, I'm not making any more. I got the chance to lose everything, therefore I'm going to shy away from it. But a risk taker might say, well, I really value the chance of making all that money. So I don't care if I'm going to lose it all. Okay. And that would be the risk taker who might indeed take the oil well project. Okay. or perhaps I need to sweeten the pie here in terms of having the expected return be higher, and then perhaps risk-averse investors will take it as well. So we're no longer just saying, you know, the value of the project is 100,000, right? We're saying the likely value, the likely outcome is a number, 10,000, and there's a second parameter, the variability, or the risk, or in statistical terms, the standard deviation, which is a measure of risk. And so it's a second dimension. In terms of our project, what we have now, and let's say, you know, rather than just the three outcomes, we sort of have a distribution of outcomes. Okay. Real estate has less risk because, yes, we've got an expected value, the most likely outcome, in other words, the highest probability outcome, but the possibilities are very tightly centered around that expected value. I.e., there's not much that can go wrong, or I can't make a killing out of it. But in the oil well, it's a much wider distribution. There's a whole lot of, you know, possibilities in terms of not doing very well. That's where the risk comes in. And here, again, we've got the expected value being the same each time, and therefore, we're going to probably, if we're risk-averse, saying real estate's for me. Okay. So I need to have some additional compensation. So the project analysis becomes a little more complicated. Because look at these two projects. Okay. In Chapter 4, we would have one number. Net present value B is greater than net present value A. And net present value always gives me the right answer, so if they're mutually exclusive, I take the larger of the two. So Chapter 4 says B is better than A. Chapter 7 now says, well, you know, B gives you more than A. However, look at the risk. It's much more, the possibility of negative outcome, or the variability of cash flows, far greater. And so now we need to ask the question, well, is the additional return, B versus A, is that worth the additional risk? And that depends on the investor and their risk aversion, or the risk tolerance. So there's a second parameter now that we have to worry about. Okay. And so we need to look at it from that point of view. Now, what I want to do is talk a little bit about why people are risk averse. Okay. Because hopefully it's sort of a given that, you know, B is better than A, but not all the time if indeed that premium doesn't adjust or compensate for the additional risk. And it comes from sort of an economic principle which we refer to as the diminishing marginal utility of money. I.e., more money is preferred to less money, but at a decreasing rate. Okay. And I want to just talk about that because most people behave as if that were the case. And let's see what that does for investments. Okay. Okay. So let me plot along here wealth in terms of dollars. Okay. This is objective, right? Number of dollars. But let me use a more subjective measure called utility. Utility, the value, the pleasure, the enjoyment, the usefulness of the money that I have. Different for each person, how they value things, their value set. But what is, I think, consistent amongst most people is the fact that if I have very, very little money, receiving a little bit of money has great utility. All of a sudden I can eat, I can buy food, I can buy housing. As I increase my wealth, it starts being less worth. Because now, rather than renting, you know, I'm eating well, I've got a place to live, I can buy a house. Well, how much better is a house than renting? Well, it is, but how much? Not the difference between, let's say, not having a place to live and renting. So as I'm moving up, each additional dollar is worth less in terms of usefulness. Okay, so, you know, you have a house, you buy a bigger house, you've got all the house you need. What do you do with the rest of the money? Well, you take in vacation. Okay. Well, you take more vacations. You're sick of vacations. As you make more money, that incremental dollar is worth less to you. Of course, wealthy people are still out there trying to make more money. You know, so yes, more money is worth, is better than less dollars, but really at a decreasing rate. And so this really is sort of an observation on human behavior in terms of how they value money. Now, how does this reflect reflect on what we're doing here? Well, let's look at possibilities in terms of investment and how might people react. My first comment is, like at the college, we hire students, and I've never seen a student turn down overtime. Why? Well, think about them being down here, okay, and we pay them a little bit of money, and all of a sudden, there's a huge increase in utility, right? You know, rather than taking your date out to McDonald's, you go to a proper restaurant, a movie, and what have you, and life is good. Okay. The utility of those small amount of dollars, great. Okay. Now, the boss asks me to work some overtime, okay, and you know, I tell him where to go. What's the utility of some extra money? I left my free time, thank you. So there's a different perspective on things, where you are in your career, you know, and you guys are going to get here sooner or later, you know, and not work any overtime either, study all hours of the night, and so it's different. Okay. So it's just sort of a common sense observation. But now, how does this affect our engineering decisions or our investment decisions? I'd like to give you an example, and this is an example I teach this course to professional engineers, sort of 30s, 40s of the telecom industry, and this example really resonates with them because they own a house. But this is a deal, if you will, and what I'm going to do is offer you several alternatives, and you tell me whether you think they're good or not. The basic deal is, okay, on the flip of a coin, so you have a house, your one and only house. Now, for most folks, their major investment is their house. That's where most of their wealth is. That's the fact of life. Now, I will give you a second house on a flip of a coin. However, you lose, you give me your house. Okay. Is that an interesting business decision? Well, what's the expected value? If I'm using the terminology from the last, if I'm just using this terminology here, weigh the individual outcomes by the probabilities to say, what's the expected return if I do this a whole lot of times? Well, of course, I only get to play the game once because I only got one house. Okay, well, let's have a look. Okay, so I've got the expected value. Well, 50% of the time, assuming it's a fair coin, I'm going to get zero house. Right? And 50% of the time, I'm going to get two houses. Therefore, the expected value of this is one house. I.e., there's no risk premium for me entering the venture. Do it a whole lot of times, I'm on the average going to have one house. Well, most people would say, hey, this is silly. You know, you're insulting my intelligence by even offering this to me. Well, why? Well, have a look. Folks in this position might be somewhere here. Okay? So think about the additional utility or pleasure associated with having a second house. Well, it increases your wealth, right? By 1H. Well, for someone who's got a house, what is it? Yeah, it's nice having a second house. You can rent it out. You got some more revenue. Maybe go on vacation with that revenue. Whatever. It's a little bit. But think about the grief that you're going to get from your spouse and kids when you say, honey, sorry, lost the house. Well, here you're going minus one house, and from this utility sort of thing, you're way down. Okay. So the disutility of the loss, this is where the risk aversion comes in. The downside has far more grief potential, or in other words, disutility, than the upside. That's the key thing about risk and return. And it's just this observation about human behavior that drives this whole process that we've been talking about. This notion that the riskier the investment, the more the rate of return required by shareholders. That's what's driving it. So I'm going to pose another problem. And I'll say, yeah, I understand. I didn't mean to insult your intelligence by offering you this. However, let me do this. Second deal. So deal one, no one wants. Deal two. Okay. Flip of a coin, a fair coin. But in this time, I'm going to give you 4 houses. So now there is a risk premium. 2 houses. So if I enter into this deal, on average, I'm making a house. Now, what does this do? Is it interesting? You only get to play the game once. Well, as it turns out, most people are so fearful of this. They say, what am I going to do with 3 more houses? I want my one and only. So the fact that there's a 50% chance of losing overwhelms the greed, if you will, of having 3 more. Well, again, go back to this. Okay, you've got this associated with the loss of the house, but if you're up here reasonably well off, look at 3H, and yeah, you're moving along here a little bit, but still, the incremental utility is still small, right? Because you're on this curve where life is pretty good, and you don't want to, disturb this, right? You don't want to be on the street, without a house. And so, basically, most people, that have houses and that would comment on this would say, well, thanks, but no thanks. Okay? There is this notion that the disutility associated with losing the one and only is just unthinkable. Okay? So I said, okay. Let me now give you a third example, which I'm going to tie to business or entrepreneurship. The third example, EV3, is, okay, I understand you don't like my coin, all right? But let's have a roulette wheel. Okay. There are 95 spots that are yours, and there are 5 spots that are mine. Okay. Same deal. I'm going to give you 2 houses if the ball lands on one of your 95 spots. And you're going to give me your house if on those 5 spots you're unlucky and the ball lands. Okay. Is that different? Well, let's have a look. 0.5, 0 house. And 0.95, 2 house. House or houses? Probably plural, I guess. I don't know. That's an English major. Okay. Now it's sort of interesting. The expected outcome of this is more or less the same as this, which everyone says absolutely not. But I look out, these folks that own houses, and there's no thinking. You know what? There's only a 5% chance. And wouldn't it be nice to have a second house and rent it out and have that extra income? So this is tempting. Why is it tempting? Because all of a sudden we've changed the risk of this. Right? 50% is, well, all bad things always happen to me. I'm going to lose my house for sure. But at 5%, hey, it's worth a chance. And so many people, while expected value here is 2, would totally dismiss this, would certainly entertain this, and probably go home to their spouse and say, hey, should we play this game or not, and decide what to do. So this is the question. Now, is that okay there? Okay. Now let me put this into the realm of entrepreneurship. Okay. You are, you've got a house, and you want to start a business. Well, of course, most people don't have the $200,000 or $300,000 that they need to start the business. So what do? You put your house up as collateral for a bank loan. Okay, so now you have your house, you have $300,000, you're going to start your business. Okay. Is that exactly like this? What do you think? Well, if you're any good at business, there's a very high probability that you are going to keep your house and you are going to create wealth in your business. Right? So, one house plus wealth. So let me just put entrepreneurship. So there's a 0.95 chance that you're going to take this $300,000, you're a good engineer, you're going to put together a good business, and you are going to keep your house. So I've got one house plus a business. Of course, there's always a chance small businesses do go bankrupt. That indeed, your company goes bankrupt, and of course you can't pay back the loan, and the bank says, sorry, 0 house. That's small business. However, rather than a roulette wheel determining your fate, it is your skill as an engineer that determines whether you're going to be here or whether you're going to be here. And if you're really good at it, perhaps the probability of going bankrupt, if you're a really good engineer, a good business person, might be this. Oops, I'm sorry. Wrong one. Might be this. Yes, there's a small chance that your business venture will go under. You will not be able to pay back the loan. The bank will repossess your house. That's the downside. But you're good. More than likely, you're going to keep your house, and through your business, you're going to generate wealth. And so this would certainly be much greater than 1.0. If you're in small business, this is the equation you have to learn to live with. If you're going to need money from the bank will not lend you money unless you have pledged every single asset that you own. This is the fact of life. So this is the small business model. Okay. And of course, you just want to make sure that you end up here. Not there. Is that okay? Okay, good. Okay, now, I want to talk now a little bit about risk and trying to manage it in business. Again, any variability in cash flow is undesirable. And therefore, if we can mitigate that risk through some financial security, companies are likely to take it. Now, when we talked about stocks in our very simple model for stock valuation, we talked a little bit about the ways of making money in the stock market. And the traditional way is what we call holding a stock long, or taking a long position. And this is what most people would think is sort of an honest way, if you will, of making money in the stock market. So you take a long position. In other words, you find good companies, and you buy, you hold while they are creating value, they're good companies, and then when you need the money, you sell for a profit. The conventional way of making money. So many of your mutual funds or your normal investor will basically use this technique. You buy into a mutual fund, they will select the stocks for you. Hopefully, if they're any good, they will be good stocks. And then when you sell, you'll sell your shares at a profit. Okay. Now, we have a market or a set of financial instruments that help mitigate risk. And initially, it looks like these are designed only for greedy people who are willing to take risk to make lots of money, or greedy asset management companies that want to make lots of money. Okay. But I want to talk about the social value and how it works into the engineering costing, if you will, in international markets. So we use the term derivative, and this is not capital. Derivative, financial. In other words, this is not a derivative because I'm buying the stock, the value is created by the stock, I want the stock. Okay. In the second case, I have this stock, I don't want anything to do with it, but I want to make money off it. So the value is derived from the stock itself as opposed to holding the stock. Let's say I want to make a bet on a company that I think is in trouble and is going to really go bad. Or it's going to be, the share price is going to go down. Okay. Well, of course, in that situation, the last thing I want to do is hold that stock. But if I go into a short position, I can profit from the fact that this company is going to be in trouble. Now, some people have sort of moral objection to that, and, you know, so be it. But this is a reality in terms of the marketplace. So what do? Well, the short position is I get a contract from someone who has a stock, and I borrow the stock for 3 months, let's say. Fixed time period. Usually these are quarterly. Okay. And what do? Well, I think if the price is going to go down, I'm going to sell right away. I don't want any part of this stock. So sell right away. Right. And let's say the current price is $100. Okay. So essentially I'm saying I think this company price is going to go down over the next 3 months. I'm going to find someone who has a share, or many shares, who is willing to lend it to me for 3 months, because, of course, they don't believe the same thing, or else they'd be selling it right now. So I have the use of this share over the next 3 months, and then I have to return it. I've got to fulfill the contract at the end. So if I believe it's going to go down, I'm going to sell it right away. Then, within 3 months, I have to buy a share. I've got to buy back a share. And then I have to basically give share to contract holder. At 3 months. Okay. So if I'm right, and share has gone down, we're not talking about money here. We're talking about shares. So if I can buy back the share at $50 because I'm right and the company's tanked, then all I have to do is buy shares back 3 months from now at $50 and get them back. That's it. So for a small fee for the contract, I've made $50. Okay. So I'm profiting from the fact that I believe this price is going to go down. And of course, if the price goes up and it's 120, I have to buy back at 120 to replace the contract. Okay. So this is a derivative. I have no interest in the share itself, but it's a financial instrument that lets me or derives its value from the share, the underlying asset. Okay. Now, this looks like it has no socially redeeming value, these type of instruments, but what I'd like to do is to look at the foreign exchange marketplace, the foreign exchange futures, and see how in engineering that might help us. Okay. Now, with free trade, across the North American free trade, it's been much easier for Canadian companies to compete down in the United States. However, of course, they've got a different currency than we do. Okay. And as we're going through here, think about perhaps why the European Union decided to adopt a common currency, notwithstanding all the problems that we're having right now, or they're having right now. So I've got an engineering company, and they're going to place a bid on a tender in the United States. Okay. So in other words, there's a full specification, the engineers in this company do the design, do the costing, and they come up with a number. So out of Chapter 5, they've done the full life cycle analysis of manufacturing and the costs after tax, all the tax impacts, and they come up with an after-tax cost of $1.4 million. Okay. So to satisfy the contract in the United States, it would cost them $1.4 million. And remember, they're bidding on it, right? They don't have it working. And they want $100,000 profit on this. Okay. So if they put this through the mill, the net present value of this is greater than this. Okay. And so they need to put a bid in of $1.5 million. Okay. So that's their bid. And if they get the work, they will be happy. They will cover their costs, they'll make $100,000, and life is good. Okay. Now, of course, in the United States, they're going to laugh at you if you bid in Canadian dollars. Most of this work is done in Canada, and these costs, people want to get paid in Canadian dollars. Their shareholders are Canadian, you have to pay them Canadian dollars as dividends. So all of this is Canadian. This bid, if you do it in Canadian dollars, will not be interesting to your American company that's basically asking for this work. So we have to put the bid in US dollars. And let's just say, and this is a while ago, that and many companies thought the dollar would be really, Canadian dollar would be weak forever, and really didn't do anything about it. And they got a real surprise. But let's just say that we have an exchange rate of 66.7 cents. So 66.7 US. Okay. In other words, $1 US will buy $1.50 Canadian. Okay. So today, or at the time we're doing this bid, I should say, this is the exchange rate, and so this is what we can do. Okay. And so you might say, okay, well, we need $1.5 million Canadian to make this work. So let's bid $1 million US. And then, of course, we're going to be okay. Well, these sorts of projects take a long time. And let's say we've got a 1-year delivery date. So it's going to take our engineers and plant 1 year to actually make this happen. And that's part of the contract, and that's what's expected. Okay. So we get the contract. Okay. And we're busy making this. And a year from now comes along. We've got it done. Our engineers have been pretty good. We spent $1.4 million to do it. And so we deliver it, install it, and we get paid. So 1 year from now, from bid, receive $1 million US. The unthinkable has happened. The Canadian dollar has got stronger. Back in the days when exchange rates were low, people said they're always going to be low. Well, what's happened? Well, exchange rate, so Canadian dollar strong, and it is up to now 72 cents. Well, what does that mean? That means a US dollar buys 138. And so when this million comes in, the company, when it exchanges it, receives 1.38 million Canadian. Is it in trouble on this job? Well, yeah. It spent 1.4 million Canadian to build it, and it's expecting $100,000 of profit. Indeed, on this deal now, it hasn't made a profit, and it hasn't even covered its costs. So, with this international contract, we now have 3 sets of risks that this company is undertaking. Right? From the debt equity, the financial risk. The more debt they use, the more financial risk there is. So let's assume they've done the best there by being at the optimal debt equity ratio, which minimizes the cost of capital and the risk to the company. They have operating risks. The engineers happen to be good this time, but in making this product and dealing with all of the issues, the nature of the business means that there's operating risks. Okay? Perhaps it's going to cost more. Perhaps it's not going to go out according to design. Those are the operating risks. Can't do much about that. And because they're bidding on a U.S. international contract, they now have foreign exchange risk, which is a 3rd layer of risk in doing business. Well, what do you do? Well, wouldn't it be nice if you could be guaranteed $1.5 million? And wouldn't it be nice if you could bid on this job in Canadian dollars, and therefore your customer is going to pay you in 1.5 million Canadian? They're not going to do that, because they don't know what the exchange rate is going to be. So what I want to do is I want to find some derivative in the foreign exchange market that might allow me to protect myself. Okay? And they are available, much like a short in the stock market. I can have a Forex, a foreign exchange, future contract. It is a derivative because I don't want to hold US dollars. I just want to derive value from the US dollar. So what about if I could have a contract, and this is a 1-year contract, that basically says, I'm going to, 1 year from now, be able to convert 1 million US to 1.5 million Canadian. Okay. So I buy this contract, and my counterparty will, upon delivery of $1 million US, give me 1.5 million Canadian. Well, where do I find someone like that? Well, there's a very active market in the Chicago Mercantile Exchange, which deals in foreign exchange contracts. They marry folks who've got US dollars that they don't want with folks who have Canadian dollars they don't want. Yes, we could do it ourselves, but can we find these counterparts? Probably not. And so, for a fee, they will find us a contract. So what does this mean now? Well, it means that we're not making as much money because my cost has gone up. So now I've got a Forex contract, which let's say costs $10,000. My profit now is $90,000, and I'm still making money. Okay, so this is still 1.5 million. What have I done, though? I have totally eliminated that third layer of risk. Because now I bid on this contract. If I get the contract, I spend $10,000 on this foreign exchange contract, and I am guaranteed to get the $1.5 million I need to make this project work for me. I've gotten out of the foreign exchange business. What business am I in? Well, I'm in the engineering business, manufacturing engineering goods. That's what my shareholders want me to do. They don't want me playing foreign exchange markets. So the social value in this is indeed risk mitigation. Who's on the other side of the contract? Well, maybe it's an American company doing business in the United States, business in Canada, and they don't need Canadian dollars. So a year from now, they've got a contract and they're getting $1.5 million Canadian. They don't want it. And they're willing to trade it for $1 million US, which is what they need to pay their employees and suppliers. So we've got basically a swap that makes both folks better off, both companies better off. That's the social value in some of these types of derivatives. Now, of course, your counterparty could be someone who wants to make money and doesn't have $1 million US, sorry, $1.5 million Canadian, but thinks that the exchange rate will be favorable a year from now and just buys in the open market. That's speculative. And I guess we don't really care who's on the other side as long as they're covered if they can't meet the contract. So essentially, this helps eliminate the foreign exchange risk, which is something we don't want to take. It makes it much easier now for this company management to compare doing a project in Canada. Let's say we can only do one of these major projects this year. Well, now I can compare a project in Canada versus the one in the U.S., and it's an apples-to-apples comparison, because in the absence of this foreign exchange contract, I've got foreign exchange risk if I go down to the States. And now, I can now say, yeah, I've got financial risk, I've got operating risk, and that's it. And it sort of levels the field in terms of what we can do here or down there. And of course, as a company, I'd rather be able to compete in the United States and Canada than just Canada. Okay. So, what about anyone going to say, yeah, but there's going to be a loser here? What do you think? Okay. Three things can happen. A year from now, the foreign exchange rate can be where it was before, in which case there's no loser or winner. If the Canadian dollar has got stronger, then the Canadian company is the loser, because had they not had a contract, they would have made piles more money. And the American company is the loser. Vice versa, the Canadian company would be the loser, and the American company would be the winner. But that's playing the foreign exchange rate game. We're an engineering company. We don't want to play that game. So we're both happy, American company and my company, that we make our honest engineering money and not be exposed to foreign exchange risk. So this is what normally happens in the international market. We want to cover large forward costs. Okay. Please.
Is there something that discourages individuals from just converting back and forth foreign currency and making money like that?
Nothing other than the fact that there's a fee. Okay? And so if you're a small trader, the fee percentage-wise is quite high. Right? And so if you can trade millions and you can figure out which way it's going from day to day, there's money to be made. However, there's money to be lost as well if you're not good at it. Okay? Similarly, there's nothing to protect. There's nothing to say that an individual couldn't be on the other side of this contract without Canadian dollars, as long as they have the resources to make good. So the mercantile exchange will rate the other side of this in terms of their credit worthiness, because if exchange rates skyrocket and you don't have Canadian dollars, you got to buy them at a real premium, because you have to satisfy the contract. So they make sure that people have the resources to back this, so there's collateral on the other side. So, given all the problems with the European Union and the euro, why did they do it? Well, think about in Europe where you've got a whole lot of small countries, all of them in the past a different currency. If I'm in Germany and I want to sell something to France, I'm going to take a foreign exchange risk every time I expect a payment in the future, and vice versa. Okay? And given the small countries, perhaps what we really want to do is to make sure that you as a company can compete all across Europe. without all of these additional foreign exchange costs. And so what the euro does, despite all the problems we're having right now, is that it facilitates trade and increases value from that point of view because the markets now are much larger. No longer do you have to worry about foreign exchange. You know, France doing business in Germany, well, they're going to get paid in euros. But France now uses the euro, therefore all of their costs are in euros. So you totally eliminate within the European Union zone foreign exchange risk, which was there before being very costly to mitigate because on any large contracts you want to be covered. Right? Your shareholders will not be very happy if on your income statement you see large foreign exchange loss wiping out all of your profit for the year. You're probably going to lose your job if you're the CEO. And so that facilitates. I mean, the problem there now is that there isn't a central authority saying how much countries can borrow. Can some borrow more than others, perhaps in corporate. So that's what the German Chancellor and the French Premier are advocating now in terms of fiscal responsibility and oversight in terms of budgetary impact decisions in the member countries. And that might help things along, but very slowly. So anyway, foreign exchange derivatives do indeed add value, and they help companies mitigate risk, and it's a very, very common practice. So let me just sort of summarize this in terms of how we might, in our project analysis, incorporate these sorts of concepts and what it means for project selection. Well, oftentimes what we do is we look at projects and try to categorize them in terms of, well, what's the perceived risk that we think our shareholders will view our project in. And replacement analysis, you know, where we know what we're doing and, you know, anyone can do that and the insurer can do that and there's nothing to it. Maybe we want to just have a fairly low hurdle rate because those low-lying fruit. We replace the equipment, there's no risk, we're going to get savings, let's do whatever we can. Normal business risk, well, you know, our customers might be fickle and they might not decide to buy from us, there's more risk. Or speculative projects in new markets or new countries have more risk attendant with it, and therefore we might want a higher rate. Okay. And so what we might want to do is try to translate, you know, this sort of risk aversion, I'll have this chart up there, so I don't, into higher returns on investment to reflect the risk of the projects. Well, what does that do to the project selection process? Well, if I have an investment, in the past in Chapter 4, it's either yes or no. Well, now it's a question of, well, what is the perceived risk in terms of whether we should do it or not? If I have a $100,000 investment, if I have it in, let's say, machine replacement, where I'm getting, let's say, $30,000 worth of savings, it's a really good project if I use a really low discount rate because there's no risk. So yes, it's worth doing. If I have that same project and it's normal business risk, so perhaps expansion, you know, into an existing product line, it's still worth doing. But if I'm going into a very risky project, what we're saying is $30,000 a year is not enough for our shareholders in terms of risk premium, because at 18%, this project is very negative, and it's not worth doing. Okay? So one way of factoring in this risk factor is by increasing the discount rate commensurate with the perceived risk of the project. And then we can decide, well, whether it's worth doing in terms of risk and return. Okay? So that's one way that we'll be able to factor things in. Okay? So I think that's probably about time now. Okay, so next day I want to talk a little bit about sensitivity analysis, and I'd like to take some project analysis from both chapters 5 and 6, and talk a little bit about sensitivity and break-even analysis, just show how it works, and sort of review 5 and 6 as well. Okay, so have a great weekend.